Hello, Unitholders in Soilbuild Business REIT are meeting for only the second time on Tuesday, the 21st of April. The first time they met, the REIT had only just listed. This time around, they're considering a whole year's performance. And these are the three main issues. The first is the acquisition of new properties, both announced during the financial year and also since then. Second is the resolution of the JTC land rent issue. And third is the way that the industrial property market in Singapore is performing and the outlook. Now, Soilbuild Business Space REIT owns a total of 10 properties all around Singapore, and you can see that here on page 17 on this map. Two of those properties are business parks, high-tech space, but they make up 40% of the valuation, so they're very important in terms of the composition of the portfolio. What you can see here on this page is a breakdown of some of those metrics. Firstly, the valuation of their assets is now at $1.03 billion. That's $100 million more than last year. And that's firstly because they've acquired new properties. You can see that there from 7 to 10. They acquired an $18 million property in February in Senoko Way. There was the Kian Teck Lane acquisition. That was worth about $24 million. And later in the financial year, they also bought a property in Tuas Bay Drive. So from 7 to 10 properties, from $930 million to $1.03 billion, and factored into that too is a slight upward revaluation of their existing portfolio. Now, since the end of the financial year, they've acquired another building, or at least announced the acquisition, the Technics building in Loyang Way. That acquisition has obviously not yet closed. It was just announced, but might also feature in the conversation at the AGM. They're spending $97 million on that acquisition if all goes well. Now, a couple of other important factors to note here on this page, and that is the tenant mix. The number of tenants has increased only slightly from 104 to 111, but the top 10 tenants actually make up 41% of their gross rental revenue. So there is quite some concentration in terms of where their income comes from in these top 10. The tenant mix is basically between MNCs, the multinationals making up 7 out of 10, with the remaining 3 divided, mostly SMEs, but also some government tenants. The weighted average lease to expiry, in other words, the average time until those leases have to be renewed, is about 4 years. So there is a little bit of time that they have in order to get those rental increases over the line. It seems that some of the reversions during 2014 were up about 10 or so percent. So it seems that they are able to still increase the rents on their tenants. Here's a chart which breaks that out in further detail. So even though the weighted average lease to expiry is 4 years, you can see here that 2018 is going to be important because the amount of space, although they're in green, is not as much, is not a breakout number, shall we say. The amount of money that comes from that lease that's going to be renewed in 2018 is quite significant. You can see that in the gold bar. So 2018 is going to be an all-important year, and page 14 is where you can look to get a closer look at that chart for yourself. On to the subject of debt, which is an important issue for all real estate investment trusts. Firstly, because the REITs have to go into debt in order to buy the properties. Sure enough, there's IPO proceeds, but they usually take on loans to actually acquire the assets that then make up the REIT. But also, the REITs usually borrow against those assets in order to buy more assets. To an extent, it actually makes sense to go into debt to buy more, but that's a conversation for another day. What's important here is that for every dollar's worth of assets, Soilbuild Business Space REIT has about 35 cents worth of debt, pretty much where they want it. Between 35 to 40%, they say. They pay an all-in interest rate on average of about 3.2%, and about 82% of their debt is fixed or hedged so that they don't suffer any surprises, as it were, if and when interest rates do end up going up. They have $370 million worth of debt at the moment. On page 112, you can find this graphic, and it'll show you when that debt is due. Now, the average time that they have until they have to repay the debt is about 2.1 years, they say. And this table here gives you the breakdown as to the year and how much is due in that year, about $95 million or so every year. Having said that, this table is probably a little bit superseded by events because since the end of the financial year, they've had to take on more debt. And that's in relation to the resolution of the JTC land rent issue, which you can read about on page 130 of the annual report or check out the disclosures to the Singapore Exchange website. You see, what happened back in April of last year was that JTC sent a letter to the manager and said, we've made a mistake. For the Fusionopolis property, the so-called Solaris property in Fusionopolis Way, they had undercharged on the rent, they said. Initially, they had levied a rent of about $405 per square metre. This is for the above-ground parts of the property. But in actual fact, JTC says they should have charged more than double. They should have charged $855 per square metre. Now, clearly, the manager of Soilbuild Business Space REIT wasn't terribly happy with that, but couldn't come to an arrangement with JTC. So they took the matter to the High Court to decide. And the most recent announcement from Soilbuild Business Space REIT is that they had a resolution. Now, that resolution postdates the annual report, the financial year, but is obviously again going to likely come up for discussion at the AGM. In essence, what that resolution means is that they are going to have to pay a very significant amount in advance rent. So it seems the arrangement they came to is a concession that yes, they will have to pay JTC for the additional rent, but getting something of a discount. Now, the way it works is that Soilbuild Business Space REIT will pay $55 million out of a total $74 million upfront land rent payment. And SB Solaris, which is in fact owned by the sponsor of the REIT, is going to cough up another $19 million. So the question is, where is Soilbuild Business Space REIT going to get those $55 million from? They only have $20 million in their bank accounts. And the answer is an interest-free loan from SB Solaris, once again from the sponsor. So the REIT says it's showing how the sponsor is doing its best to support the REIT, to show that they are continuing to take care of the real estate investment trust. It's perhaps the best resolution that you could get out of a very unhappy situation. I mean, initially when JTC wrote to them in April last year and demanded the extra land rent, Soilbuild said this works out to about $3.5 million a year plus GST. So if you multiply that by the number of years, it works out to about $90 million by my back of the envelope calculation. So the fact that they're paying $74 million seems to be a bit of a discount. The other reason why this was possibly going to be so damaging is because of the building valuation. If JTC had just gotten its way with the rental increase, that would have weighed on the valuation of the Solaris building, would have taken that valuation from $300 million to $275 million. Now that they seemingly have this agreement in place, it means that the valuation will actually go up from $300 million to $355 million. So once again, the issue seems to be resolved, but it does mean that obviously more money will go the way of JTC, and perhaps that's again going to be the subject of discussions at the annual general meeting. So that takes me to the third and final issue to look at the AGM, and that is how the fundamentals of the business are performing, what the outlook is, how is the Singapore industrial real estate market. First, let's take in the numbers just reported. These are obviously now audited, seeing that they're in the annual report. These aren't comparative numbers, but at least they show you what the actual figure was compared to the forecast. And here we have firstly the gross revenue, almost 3% higher than forecast. The net property income was 4% higher, partly because of lower than expected property expenses. The reversions have been pretty good, they say, up about 9.8%, say 10% higher rents than they charged previously. The income available for distribution was up 3.5%. There were certainly higher finance charges because of the additional debt, which I mentioned earlier on, but at the same time, the higher management fees also weighed because ironically, they had better than forecast net property income, but as a result, they had to pay a higher performance fee to the manager. This is the distribution per unit, almost 4% higher than their forecast. Now to the outlook, and you can read about that in the Chairman and CEO's statement. In essence, what it says is that the Singapore industrial property sector still has a mixed outlook for 2015. And in essence, they say that the The tenants are going to be still very price sensitive when it comes to renewing their leases. They're worried about the back of declining manufacturing output in Singapore and the fragile global economic outlook and lingering global risks. Therefore, while rents for conventional industrial space may not fare as well as the business park rents, they're still expecting quite a lot of people to move out of expensive office space and into business parks where they can get cheaper rents. So on the one hand, industrial space, a lot of supply coming on, economic outlook not so great, but their high-value business park space is likely to benefit from higher rents in offices. All up, they say, they're still expecting a stable performance in 2015, provided, of course, that they can jack up the rents for their existing tenants who are going to renew their leases over the coming year or so. Page 136, this is where the notice for the AGM is. Read all about it with all the resolutions that are going to be put to shareholders at the Suntec Singapore Convention and Exhibition Centre on Tuesday the 21st of April.